Hey everyone, thanks for joining the webinar today. I'm David Walston, CPA, the owner of the business. So we're going to talk about mastering your taxes. I could talk a lot, probably spend several hours on a whole different niches and areas of the tax code on things you can do and shouldn't do for your business. But we're going to try to concentrate on some more general topics. So if you want some specifics, definitely reach out to us and we can set up a meeting and go over any specific questions or details you have. But a couple housekeeping items. If you have questions as we go through the slides, please feel free to throw them in the chat. We will grab them during the Q&A sessions. We have a couple throughout the slide deck as we go along, as well as we will be providing the slide deck to those who registered for the webinar on our website, since we have your contact information. So if we don't have your contact information, or if you didn't register there and you just hopped on because it's part of our YouTube channel, go to our website and check out the link for that. I can have someone throw it in chat for you. So what are we going to cover today? Well, we're going to talk about, first off, why tax planning matters. I think it's important to set the purpose first before we talk about things you can do. It helps frame it better in context of what you should be thinking about and not just about not paying taxes, because that's not a tax strategy. Then we're going to talk about individual things that tax strategies or things that individuals can do for their tax strategy, or just different credits and stuff that applies to them. And then we're going to talk about business owners, things for them, and then a couple special circumstances, and then different things towards the end there. And then we're going to have Q&As after the individual's business and then at the end. So if you have questions, like I said, throw them in chat and we will get to them as we do, as we get to that Q&A section. Today, forgot to mention earlier, this webinar is going to be probably 45 to 50 minutes. Depends on how quickly I talk and how many questions you ask, of course. So we might fill up the whole hour. We might be a little bit under that. So just to set that expectation there. So what's the purpose of tax planning? Well, first off, it's to understand your tax liability for the current year and into the future. So you want to kind of get an idea of how much in taxes you're going to owe, when and where. And then the goal should be to align those tax liabilities with your personal or business goals. So the goal in tax strategy and tax planning isn't to say, I don't want to pay any taxes. It's to make sure that your personal and business goals align with your tax strategy. And sometimes that can be paying no taxes, and sometimes it is okay. Sometimes you're going to have to pay taxes, because a lot of tax strategy is about pushing taxes into the future as far as possible. So at some point you're going to pay taxes. It's trying to control when you pay those taxes instead of just paying them. So that's the last part here, is you're trying to control the timing of those payments to align with your personal and business goals, rather than just paying the tax and moving on. So one of the reasons we like to do year-end tax planning, though, is, guess what? It helps you reduce your stress a little bit, because, hey, maybe you had a really good year, don't know what your tax liability is going to be like because it's different than prior years. We can sit down with you towards the end of the year, do some quick forecasting to see where you might land, and to give you an idea of your tax liability in April when you file your taxes. It also allows us the opportunity to do a couple things. Maybe there are some things you could do towards the end of the year before the year ends that you need to do before December 31st to affect your tax liability. There's oftentimes time limits on certain tax strategies, so making sure you fit those in before the end of the year is good. It can help you keep more of what you have earned, avoid underpayment penalties, and then help with long-term stability. So for individuals, when we talk about individuals, that is just a W-2 employee. You really don't have anything else going on. And the reason we structured the presentation this way is because if you don't have anything other than a W-2 and maybe a couple investment accounts, your strategies are much more limited because you don't have these other things going on. We'll talk about those later on. So these strategies are just directly for a W-2 employee. Do they apply to people who own small businesses and stuff? Yes, because if you get a W-2, you can do the same similar things, but this is just for people who have W-2s, and later on we'll talk about business owners and the additional things they can do. So this kind of applies to everyone, and then we'll get more specific with business owners later on. So the three main things we're going to look at is utilizing itemized deductions, contributing to retirement accounts, tax credits, and then the new deductions related to the one big beautiful bill. All So before we talk about itemized deductions, we have to talk about standard deduction, because the purpose of itemized deductions is to collect enough expenses that you're allowed to claim to get over the standard deduction. So if you don't know what the standard deduction is, it's just not really helpful. So the standard deductions for single and married filing separately is $15,750. Head of household is $23,625, and then married or surviving spouse is $31,500. Caveat on that for the first one, married filing separately, is if you are married filing separately, and this is why I don't recommend doing that, is that if your spouse is claiming itemized, whether or not you have enough itemized deductions to get over that $15,000, you're required to itemize. Same if your spouse is filing the standard deduction, you as this married filing separate person would also have to claim the standard deduction. You both have to pick the same thing. You can't do two different ones. And so if you're married, married filing joint is what you want to do. Most of the time when you file married filing separately, it's because you're either going through a separation or some turmoil there in the household. It's not normally for tax benefits, because I haven't really seen any from that. So itemized deductions, there's four main areas of itemized deductions. There's medical expenses, taxes paid, donations, and mortgage interest. So we're going to talk about what those look like and what can fall into those categories here in the next couple of slides, starting with medical expenses. The biggest drawback to medical expenses is that they have to be over 7.5% of your taxable income. So if your taxable income is $75,000, then your expenses must exceed $5,625. So that means if you had $6,000, you wouldn't get the full $6,000 as a deduction towards itemized deductions. You'd only get about $375. And so that, for a lot of people, especially healthy individuals, isn't very helpful. With the insurance premiums going up, sadly, that is something you can claim. So you can claim the portion of insurance premiums that you pay towards itemized deductions, and then other medical bills, and then medical miles. And medical miles is just any mileage that you drive specifically for medical appointments and stuff. So you have to track all that. Then we can claim it. You get a lower mileage rate than you would for business miles, but it can be somewhat helpful. It's not normally that helpful unless you drive a lot for medical expenses or medical appointments. The other thing I want to point out that falls into this category are medically necessary service animals. They have to be prescribed by a doctor. They can't be, emotional support animals. They have to be subscribed by a doctor and a certified animal, support animal. And then that animal, its expenses, its costs, and everything become medical expenses. So those things can also be deducted as medical expenses. So if you are disabled or in the hospital a lot of people will use this category a lot more often than most people who may not have that many expenses. And then the last thing I'll add there is if you are able to itemize and then you give us your medical expenses and you're only able to get an additional $1,000, that is helpful, because if you're already over the standard deduction limit, then any little bit extra can be helpful. The next is taxes paid. So the main category here is income tax or sales tax. So that is an either or. So most people do income tax because most people don't really pay that much in sales tax. The only situation you might pay sales tax above your income tax is you have low income one year and you bought a car. But the majority of people are going to have higher income tax than sales tax. So you pick sales tax, real estate taxes, and then property taxes. The new thing for 2025 and for I think 3 years after that is that the cap on sales tax, it's called SALT cap, is $40,000 versus what it was in 2024 of $10,000. And so if you have a little bit higher income, this is going to help you out because you're not going to hit that $10,000 cap as quickly as you would the $40,000 cap. Oh, I forgot to do the slides. Sorry, that was my fault. There we go. So we'll go back here. I'll go back over a couple of these slides real quick. It happens. So these are I'll go over the numbers real quick so you can see them. And then, like I said, we'll provide the slide deck to everyone after the meeting. So here's your standard deduction items, like I was talking about before: 15,750, 23,625, and 31,500. So your itemized deductions need to be more than these three levels for it to matter at all. If they aren't, then you're going to just take the standard and go from there. So here are the things I was talking about. Medical expenses. I talked through all these numbers here, but there's your new limit there for the SALT cap at $40,000 versus the $10,000 for 2024. So moving on to the last two expenses. Mortgage interest deduction and the charitable donations. So mortgage interest, there isn't a cap on that necessarily. There is a cap on the mortgage that you can deduct the full interest from. Most taxpayers aren't going to hit that cap. So if you have a multi-million-dollar home that you purchased and have a mortgage on, talk to us and we can let you know how much of that mortgage is actually deductible. But for the majority of taxpayers, 100% of their mortgage interest is something that they can try to use for itemized deductions. In addition, you can use HELOC interest, but that HELOC interest has to be for improvements to your primary residence. So you can't get a HELOC and then like buy a new car or, improve a rental property or anything like that. It has to be improvements to the primary mortgage, and then that interest is also deductible as part of the mortgage interest deduction. And then the last one is charitable donations. So this includes cash, non-cash items, and then charitable miles. Just like medical miles, the mileage rate is lower than the standard mileage rate for businesses. So this is really for if you're volunteering for a charity and you do a lot of driving. If you track those miles, we can put that on your itemized return and hopefully help boost your itemized deduction. The biggest thing here is for donations, non-cash donations over $500. That requires an additional form, so we will need additional information from you on that. All right. So there's limits that apply as well to the donations. So you can't just, if you make $100,000 and donate $100,000, you actually don't get to deduct the whole $100,000 that year because you're limited to 60% for cash donations and other percentages for other types of donations. All right. And then we're moving on. So that's itemized deductions and standard deductions. That is one of the best ways. If you are able to itemize, you want to maximize the amount of itemized deductions there so that you can take full advantage of those extra dollars, reducing your taxable income. The second way we're going to look at here is retirement contributions. So we're listing HSAs in there as well because they are a retirement vehicle, which is kind of fun. We'll talk about that in the next slide. But let's talk about retirement contributions in general. First, there's two different types of accounts: Roth accounts and traditional accounts. If you're not aware, Roth accounts, you don't have a deduction. You pay tax on that money as it goes into the account, meaning you don't reduce your taxable income when you contribute to a Roth account. But when you pull out of a Roth account, the funds are no longer subject to tax. So you don't pay tax when you pull out of a Roth account, but you pay tax when you put into a Roth account. Traditional accounts, when you contribute to the account, they reduce your taxable income. But when you withdraw from those accounts at retirement, you pay tax on those. In addition, with traditional accounts, you have a required minimum distribution. So that's calculated based on your age and the fair market value of your retirement accounts that are traditional. So that is another consideration when you're doing tax planning is, do you think you're going to have less income in retirement or more income? And based on that, kind of can dictate which account you throw your money into for tax advantages. In addition, you can do a Roth rollover where if you have a low income year or you think you're going to have negative taxable income in a year, you can take money out of your traditional accounts, pay tax on them, and put them in the Roth account. So there's a bunch of different things you can do, and that's why sitting down with people and going through your retirement and tax strategy is important. So normally when we talk about retirement accounts, for tax planning for individuals, we try to work with their financial advisor as well. So everyone's on the same page and we know what's kind of going on. In addition, there is a retirement credit. It's called the Saver's Credit, and we'll talk about that later during credits that you can possibly get which can make contributing to a Roth, depending on your income level, more valuable than contributing to a traditional for that year. And then the last one, sorry, this isn't HSAs yet. This is more information for retirement. I forgot about that. So there's two different main types, and that is the business retirement accounts and individual accounts. If your employer offers a match, you should definitely contribute up to getting that max match contribution, because that's free money that you get regardless. So it's just generally a benefit anyway. But the thing I'll mention here that I didn't really mention during itemized, because those are things you're going to have to pay for no matter what, is a lot of tax strategies rely on you spending money to get tax savings. And so it's a balance of cash on hand, how much cash you have available and need, versus deferring tax liability to the future. So if you don't have the cash now to contribute to increase your contributions to a retirement account, that's okay. But if you do, that's definitely a way to do it. So with 401ks and 403bs, I believe the max you can contribute is like $14,000. And then for an individual IRA, the limit I think is $6,000 to $8,000 depending on your age or something like that. But with the IRA, the nice thing about that is you can contribute to that account up until April 15th of the following year. So if you would like to make that contribution, if you don't have the money right away, but you think in the next 4 months after the end of the year, you'll get the funds, you could still contribute for the last year to that retirement account and get that deduction possibly. There are income limitations to your contributions to the traditional IRA, so you want to make sure you talk to someone about that before you make that decision to just contribute. And then the last retirement vehicle, like I said, is an HSA. Most people don't consider this a retirement vehicle because it's for medical expenses, but if you're unaware, you can actually use it as a retirement vehicle. The funds you put in there, you can invest in the market, and then in retirement, you can pull funds out of the HSA account tax-free. So it's it's ideal because it helps you reduce your tax liability or your taxable income when you contribute. You can cover your medical expenses if you have them, but you can also invest the funds, and they can grow tax-free, and then you can pull from that account in retirement. So HSAs are a fun way to kind of double dip into reducing your taxable income by contributing to retirement. Because if you could throw money in the IRA of $6,000 to $8,000, you can put another, depending on if it's a family, if you have a family plan or not, up to $6,000, I believe, in an HSA. So it helps you put a little bit more money away and reduce your tax liability at the same time. So HSAs are fun, something to keep in mind when you're looking at retirement plans. All right, tax credits. There are a lot of different tax credits, like tons and tons of them. Individuals, there are less tax credits than there are available for businesses. So these are the main ones that people kind of know about. I'll add one additional one, but that's okay. So child tax credit, this one's obvious. If you have kids, you automatically get, I think it's $2,500 per child per year now, with the one big beautiful bill that increased from $2,000 to $2,500. And so each child you have under the age of 18, you get the $2,500. There are income limitations. Most people don't hit those income limitations. So that's an easy win. And then along with that, you have the child care credit, meaning if you and your spouse have earned income, so you have to show earned income, W-2 wage or other earned income on your tax return. Then if you have your children in some sort of child care during hours that you work, we can use that to get you a child care tax credit. So an additional tax credit on top of the child tax credit. So that's an additional credit you can do. And then educational credits, those are good. So if any of your kids in school and they are reported as dependents on your tax return, any expenses that are not covered by grants or other monies like that. So if you're getting student loans to pay for college or things like that, you can get an educational credit for those. And depending on how many times you've claimed a credit and different things, you can get really, really good credits, or lifetime learning is still a good credit. It's just not as good as the American, I don't remember the whole name of it, the AOTC. Energy efficient credits, a lot of these have been curtailed with the One Big Beautiful bill. So most of the EV and solar credits are gone. There are still some home energy efficient credits. So if you upgrade insulation, your HVAC system, and some other things in your house, you still might be able to get credits for those. So let us know if you do anything like that. And then lastly is the Savers credit I mentioned earlier. You can get up to $1,000 for a single individual or $2,000 for a married couple. And that income limitation is $38,000 for single and $76,000 for married. So the benefit of credits versus deductions is they directly reduce your tax liability, where deductions just reduce your taxable income. So the way I tell my clients to look at it is you want to figure out what your effective tax rate, and most people's effective tax rate is between like 12% and 22%. So depending on your income range, your effective tax rate is not the tax bracket that you're in, but is the effective tax rate based on the total tax you pay, or your total tax divided by your taxable income. So you want to figure out your effective tax rate, and then you multiply that by your extra deductions you're thinking about creating, and that gives you the tax savings. Where with credits, it's a dollar for dollar. You just take the credit and it reduces your tax liability by that exact amount. So the last page here is the One Big Beautiful bill, the new deductions there. There's 4 main ones for individuals. There's a bunch in that bill. So if you have more questions, feel free to check out our webinar on our YouTube channel about the One Big Beautiful bill. I'm not going to go into tons and tons of detail on these here. I'll just give you a quick overview. As you can see there, for anyone over 65, there's a new $6,000 deduction. So you don't have to do anything special to qualify for that. It's just based on your age. So if you're over 65, get $6,000. That is supposed to offset a portion of your Social Security that is taxed. And of course, there are income limitations. So if you make a ton of money, you may not get that deduction, or it may be partially phased out. Then the no tax on tips. Qualified tips up to $25,000 you get a deduction for. So how tax on tips and overtime work is you still report your gross income on line 1 of your tax return for the full amount. So if you make $100,000, you're still going to throw $100,000 up there, and then you'll get a deduction for that. Those tips are overtime elsewhere that reduces the gross income. So it's going to be a little bit weird because for this year, the IRS has announced that for 2025, they're not changing any of the tax forms. So your W-2 is going to look the same as it always has. And for tips, that can be okay because there's a tips section there. So if you make tips, we might still have that information that we need. For overtime, there is no section on the W-2 to report overtime. And so we'll see what people do on that. But for 2025, essentially, you're going to have to give your tax preparer more information to qualify for no tax on tips or overtime. So to let us know how much of qualified tips and overtime you have. And then for tips, you also have to let us know the type of employer you work for, because only certain specific types of employers tips are deductible. So we have a blog post about tips, and we're going to be putting up blog posts about overtime and car loans and the other deductions as well to give you the details there so you kind of know what's going on. But you can also always ask us as well. The last one there is a little bit weird in that there's a lot of intricacies into getting that deduction, but there is a new deduction on car loan interest. It is for new cars or new loans in 2025. So if you bought a car in 2025, let us know and we will see if you qualify. Or if you refinanced your car in 2025, you might qualify, but that's capped at $10,000 or the total of your qualified interest. So let us know about that. And like I said, check out our webinar on the One Big Beautiful bill, and we go into more detail on the different sections of the One Big Beautiful bill. But I thought these are important for tax planning purposes since they are for 2025. So there's going to be a lot of people who can take advantage of them and get higher refunds because of those items. All right. So do you have any questions, or are there any questions about that information? All right. So do have a question. Let me look here. Yeah, you can actually, yes. So even if you are over 70, what is it, 71 and a half? I can't remember the exact age. And you're in the age bracket of having to require minimum distributions, you can still contribute to your IRA accounts. And as long as your income is below the thresholds, so that you can still claim that that as a deduction, that can reduce your income. But the thing to remember is that the way the tax brackets work, if you're $1,000 into the next tax bracket, that $1,000 is only taxed at the higher rate. And so normally your effective tax rate only changes a little bit. So it's worth, maybe meeting with us or giving us a call. And so we can run through those numbers to give you an idea of what the tax difference would be for those two amounts. But like I said, if you're doing a contribution for the deduction to an IRA, as an older individual, you get an extra $2,000, so you can do a little bit more money. What you want to do is you take that money, take that deduction or the contribution amount and multiply it by your effective tax rate, and that tells you how much in tax you're saving by making that additional contribution. Because it's not a dollar for dollar, it's a deduction to taxable income, and then you get tax calculation on that. So the car loan interest is a kind of a pain. It's kind of detailed. The biggest thing with it is there's a certain percentage of the car that has to be manufactured in America. So there's a list. There's a website with a list. So for us to be able to claim the deduction, we need your VIN number, the car, and then we need information on the loan. So if we have that information, we can look it up and see if you qualify. And it has to be purchased. It has to be a new car. You have to be the first purchaser. So you can't buy a used car. You have to be the first purchaser of a new car, and the loan has to originate in 2025. So if you were the first purchaser of a new car that qualifies, but you purchased it in 2023 or older, but you refinanced in 2025, there's a possibility that loan still qualifies for the interest deduction, but it is a little bit more complicated than some of the other deductions. So we'd have to get information on the specific vehicle and loan and all that stuff and figure out if it actually qualifies. So that one's a little bit more complicated, but there are going to be people who qualify for that. Oh, that one I have to look up. I don't remember that information off the top of my head for Medicare, so I'll pull that information and I'll have to get back to you on that. Oh, that's the other thing I wanted to mention. Missy put it in the chat that if you're attending the webinar today, you qualify for a free 20-minute tax planning seminar. We can just set up and talk for a bit and figure things out together. So let us know, reach out through email or whatever, and we'll get that set up for you. Are there any other questions? All right. Nope. All right. There's one other question we received through email. Where did I put those things? That I'll go over real quick. Where is it here? Someone was asking about upgrading their appliances. So if you, sadly, their appliances don't qualify for energy efficient improvements. So any of the appliances that you see at the store that have like Energy Star ratings or things like that, that is all for the manufacturers to get tax credits, not for the people who buy them. So the only energy efficient improvements that you can get a tax credit for are insulation, HVAC, and other specific type of things like that. So if you're doing that kind of stuff to your house or putting in new windows, those are things that we could get tax credit for, but not appliances, sadly. So the question about inheritance is, so there's this cool thing you can do. It's called a donor advised fund. So if you got a large amount of money and you want to throw a good amount of money into donations, but you weren't sure what charity to give to, or you wanted to give it over a large period of years. Excuse me. But you still wanted to give that donation. You can put it into a donor advised fund. It is an investment account that gives you a tax deduction when you put the money there, but you can put it into investments once you get it there, and then over several years you can take the funds and put them donate them to nonprofit organizations. So it's a way for you to kind of front load donations to get a better tax benefit. This came out when the standard deductions were increased, and one of the suggestions people made was, if you normally give X amount of dollars year over year to charitable organizations, if you have the cash available, instead of doing that directly to the charitable organization over a 2-year period, do it all at once to a donor advised fund, and then that year you're able to itemize and then give it to the nonprofit over the next 2 years, and then the next year you only take the standard. So it's a way for you to kind of take advantage of the higher standard deduction and still give to charities like you normally would. So it's a fun account. If you want more information, feel free to ask and we'll talk about it. That's the other thing I wanted to mention about retirement accounts. So individual IRAs, if you have a spouse who doesn't have a job and doesn't work full-time, or is a stay-at-home mom, which is a full-time job but that they don't get paid for, you can still contribute to your spouse's account. So you can both max out that IRA contribution limit even if your spouse doesn't work. So there are different limits that apply to someone who doesn't work than does. So your income actually can be still high, and your spouse could contribute, and you can get a deduction where you, as the one who's earning the wage, wouldn't necessarily be able to get the deduction. So it's a weird thing with the tax code, but it is interesting. I think that's all for now. We'll move on to businesses. So what we mean by business owners is anyone who has a Schedule C, so that is a sole proprietorship on your personal tax return. 1065, so you get a K1 and you file a separate tax return as a partnership. 1120 or 1120S, which is a corporate return, and a S-Corp return. So those are all in the business category for tax code benefits. So the tax code is really geared towards business owners versus individuals. There's a lot more things that you can do. And the biggest difference I like to tell people, because it's a little bit more simple, is that business owners are taxed on their net income, gross income minus expenses, where individuals are taxed on their gross income. That's the major difference there between a business owner and an individual from a tax perspective. In addition, businesses have a lot more tax credits and other things available to them where individuals do not. So if you are a sole owner and employee of your tax strategy is going to be different than a business with employees. So depending on your size, your goals, there's a bunch of different things that you may want to do differently as a small business owner, where individuals, they can more fall into the same types of tax strategies where business owners, based on your size, how many employees you have, what you're trying to do, can create a bunch of different tax strategies that you might want to get into. As with individuals, the tax planning goals for businesses are similar. We want to know what our future tax liabilities are and align our tax strategies with the business's overall plan. Paying no taxes is not a strategy. So there's 3 general strategies I see, and there's a ton of variations in between these 3 strategies. But the main strategies to see for business owners are growth. And so business owners who are focusing on growth are looking for spending the least amount of cash, on taxes. They're going to spend most of their cash on the growth of their business, and so they're looking for ways to reduce their cash output so they can take as much cash and throw it back into their business for growth as possible. Because growth is a very cash-intensive strategy. So for most business owners who are looking to grow are looking for a strategy that relies on the time value of money. So what that means essentially is $1 today is worth more than $1 tomorrow. And so we're looking to push tax liability as far into the future as possible so that you can reinvest those dollars into your business and grow it and get that return on investment as quick as possible. So they're aware that in the future at some point they're going to have to pay taxes, but right now they're trying not to. And so a lot of times we're trying to figure out ways for them to spend money or allocate resources in a way that they get as low as tax liability as possible today, and are fully aware that in the future they're going to have to pay taxes as they grow. The second group is business owners who are kind of in the maintenance area. And what that means is they're well established. They're not looking for their business to expand a lot. I mean, if they get new customers because they have a good brand, they're fine with that, but they're not actively out there advertising and trying to grow and add employees and make things better. And so a lot of times they're looking for making sure that they maintain their year-over-year margins and profit because they like their lifestyle they've built to this point. And so they're looking to understand what their tax liabilities are going to be year over year, what credits or things that they can get while doing their normal course of business that can help them maybe reduce their tax liability, but they understand they're not going to pay zero, and they just want to understand how much they're going to pay so they can make sure they pay it timely and avoid any penalties or issues with that. And then the third type is probably the most important in the realm of how much taxes we can save them, is people who are looking to sell. If you're looking to sell your business, the reality is you're going to have a large tax bill when you sell that normally. And so what you want to do is you want to get the most value out of that sell. And there's two ways that we do that. First is we want to make your business look profitable and more valuable year over year. A lot of times small business owners will pay for things that are definitely business expenses, but the new owners wouldn't pay for them. And so if we can remove those out of the business and make your bottom line look even better when we file your taxes, that is helpful for evaluation purposes and such. And if you're not a publicly traded company or you don't have annual audits, a buyer is going to ask for the last 3 years of your tax returns to do evaluation of your business. That's going to be where they start. So if we can make those look really, really healthy, that helps up the value of your business to that buyer. And then the second part, if you work with us soon enough, we can hopefully avoid a large portion, if not all, of the capital gains tax related to the sale of your business. So if you don't know about the qualified small business tax sale, stock sale, sorry. It is a way for us, if we have 5 years, to work with an attorney and legally change your business so that you qualify for this, so that in 5 years when you sell your business, you can avoid close to 100% of taxes, if not 100% of all your taxes on the sale of your business. And so these three categories kind of take a different approach with tax planning as tax strategy. But the biggest thing here, even with personal as well, is the more information I know about you personally, what you're doing, things you're spending your money on, what you're trying to do with your life and your business, the better I can be like, oh, because you're doing X, we can try to do this strategy or this thing to help reduce your taxable liability. So that said, because those are kind of unique and each business is different, I'm not going to build out a strategy because I don't know what any of you guys in the audience are looking for specifically. So instead of doing that, we're going to just talk about the different tax deductions and credits and things that business owners can get. And then if you want to build out a strategy based on what you're trying to do with your business, we would love to chat and take care of you there. So the biggest thing with a lot of tax strategies about timing, we want to time income and expenses to either reduce tax liability or move things around so that you pay less taxes in 1 year versus the next year. So the best way to accomplish this in a business is through leveraged assets and retirement contributions. Those are the main two easiest ways. There's a bunch of other things, like I said, I could spend hours talking about it. But those are the two main ones that are the low-hanging fruit of tax strategies that we can easily implement without a whole lot of overhead. So leveraged assets, if you're not aware, assets are anything that has a useful life of more than a year. So a leveraged asset is that you purchased with debt. And so why this matters is that normally assets reside on the balance sheet and you don't get to expense them immediately, so that you don't get to deduct them from your gross income and reduce your tax liability immediately. But because of bonus depreciation coming back to 100% and that being made permanent with the one big beautiful bill, this allows us to take some of those assets that would be normally on your balance sheet and throw them as an expense onto your profit and loss against your taxable income. So for example, if you bought an asset for $70,000, only put $14,000 in cash down, we can normally still take the full deduction of $70,000, even though you didn't pay $70,000 in cash. This is one thing that real estate investors do a lot, especially with the bonus depreciation, is they'll buy assets. So my example down here is you buy a commercial building for $1 million. Normally you'd only get a $25,000 expense annually from normal depreciation on that asset, where we can do a cost segregation study and take a $200,000 upfront hit and then $20,000 annually after that. So that allows us to front load a tax loss, which is not you losing cash. It is just on paper a loss for reducing your tax liability the year you put assets into service. And then you can take that cash that we saved you and hopefully reinvest in your business and make a better return. Because leveraged assets are treated as fully paid for tax purposes, the strategy can create early losses and defer taxes into taxable income into future years. The thing to remember with leveraged assets, though, is if it's a one-time purchase, you just have to understand that it's going to just affect that 1 year, and then the following year, you're going to have a tax liability. So unless you're purchasing the same type of assets year after year after year, you're going to have a year where you have a larger tax liability because you use this strategy. But normally with business owners, because of the time value of money, it's better to get that upfront savings and then reinvest it and pay the tax later. So retirement plans for small business are a little bit different than individuals, and that's because you are the employer and the employee. So that gives you a little bit of unique benefits. So there's a ton of different variations on retirement plans, but the three main ones are simple IRAs, SEP IRAs, 401ks, and defined benefit plans. You can do a combination of a couple of those plans to increase the amount you can throw into retirement, but the important thing to remember is if you have employees and your ownership in the company if you have employees. So if you own 70% of or more of a business with employees, your retirement strategies are going to have to include all or most employees depending on the type of plan that you implement. In addition, you can also contribute to IRA accounts, but if you have higher income, those contributions don't help you. So most of the time we concentrate on your employer plans and how to use those. So if you have less than 70% ownership and have employees, or you're the only employee, we can implement owner-only retirement strategies tailored just to you. And so what this allows you to do if you don't have employees is you can possibly, depending on your age, put it away $100,000 to $200,000 a year into retirement. So if you're making tons of money, we can offset your taxable income by a large portion if we combine some of these plans. Or we can just use one and you can do like $50,000 to $70,000 as well. So you can put a large amount of money into a retirement plan as a small business owner versus an employee, where your cap is, I think, $14,000 for one of these plans, and then an additional $6,000 or $8,000 ish for the IRAs. So as an employer, you have a much better ability to throw large sums of money into retirement to defer that tax liability than you do as an employee only. So again, with these strategies, we talk to your financial advisor, figure out which one fits best with you, and then we work with them to figure out how much to put in per year and that kind of stuff. So these strategies are super helpful because they do the deferral thing that we talked about of pushing your tax liability in the future as far as possible. All right, tax credits. There are hundreds and hundreds of tax credits for businesses that you could possibly qualify for. These are just some of the most popular ones. So if you have something, or you saw something, or you have an expense that you want to see if there's a tax credit, let us know. We'll look into it. But these are the most popular ones. The small employer health insurance premium credit covers up to 50% of employer paid premiums. For all of these credits, there are specific criteria you have to meet. So it's not just like you get a plan and then you just get the credit. You have to make sure you qualify for the credit, and then we can get the credit for you. So it does take some pre-planning before you make a choice, possibly. For employer health insurance, those are so expensive. A lot of small employers just don't do it. But if you do, maybe we can help you offset some of that cost with tax credit. The R&T tax credit, that's a popular one. It's back to being R&D expenses in general are back to being useful because of the one big beautiful bill. But this credit allows you to get a credit for up to 20% of the qualified research expenses. So if you want more details on that, or you've created something, so this is for research and development for product, software, or things in general. Even if you don't actually create something, like if you're doing research and development and then all of a sudden you come to the point where it's not useful, you can't even create the product, it's not going to work out, you still might qualify for the credit. But if you do create software, hardware, products, things like that, you might qualify for this credit. The work opportunity credit, that is specifically for certain classes of individuals that you hire. The important thing to know about this is that most of the time you have to make sure that employee qualifies for the credit and apply for the credit through your state before the employee is employed or within like 30 to 90 days. And so if they qualify, it's disabled veterans are one of the employers in this category. So if you're thinking of hiring one of them, you want to get the paperwork filled out ahead of time and make sure you're ahead of it to get the credit. Otherwise, you're not going to qualify. There's a bunch of different classes of individuals that qualify for this credit, but make sure that if you're looking for one of those classes of individuals, you want to work ahead to make sure you can actually get the credit. Disabled access, so if you have to update your business for accessibility, up to 50% of that cost can possibly be covered through that credit. And then if you have benefits for paid family leave, you can get a credit for those as well. And then the last one is you also get a retirement plan credit. So like the Savers credit for the individual, businesses get a credit for retirement plans. What this one does is if you don't have a 401k plan and you implement one, we can pretty much cover the administration cost for the first year and up to $5,000. And then for, I think, 3 years after or 2 years after, so for a total of 3 years, you can possibly get a credit that covers most of the cost of administration for that retirement plan. So again, like I mentioned, under the individuals, credits are more valuable than deductions because they directly reduce your tax and not just your taxable income. So the last thing I want to talk about for small business owners is paying your children. So this is something that is pretty popular on TikTok and stuff, and people make all kinds of statements about, you should definitely do this, it's great. Well, you need to probably know some things before you try to do that. First off, if your child is below the age of 18 actually, you don't have to pay FICA wages on their W-2, but they have to have a W-2 job. In addition, if you pay them less than the standard deduction of $15,750, they don't have to file a tax return. But the important point is the last two here. The job description and the work they perform have to be age appropriate. So if you have like a 6-year-old, they're not driving a forklift. You can't put that in their job description. You can't tell the IRS they're doing something like that. It has to be age appropriate. And then two, their pay has to be appropriate as well. They can't be making $1,000 an hour. They can't be paid more than your other employees. They have to be paid for their skill level in the job, if that makes sense. So as long as you meet those or you keep those things in mind, you can definitely hire your kids. And even if they are 6, 7, 8 years old, if they're doing filing for you, if they're doing things around the office for you, you can possibly pay them and get a deduction for that. And so what I tell my clients is, if you're paying your kids and they are still dependents of you and live in your household, the amount you pay them should help cover some of their personal expenses that you would normally just cover. And that way it takes some of your personal costs and moves it to your children and therefore makes it a business cost. In addition, if you pay your kids, they now have earned income. That means they can contribute to a Roth IRA and start investing in their retirement at a young age. So those are some benefits to paying your children, but unlike TikTok and stuff, you can't just give them whatever money you want and send them a W-2 and the IRS is going to be fine. You want to make sure you give them the appropriate job and pay them the appropriate amount, and then you're good to go. All right. Any questions about that? Any questions about business deductions, strategies, things like that? Let's see. That's one of the questions we get a lot is about if you should set up your business as a S-Corp versus an LLC. So for a couple qualifying things there, first off, LLCs are a legal entity and not a tax entity. And why that matters is the IRS doesn't actually see LLCs as anything at all. They default classify LLCs as one of their already existing taxable entities. And that's classification is based on owners. So if you have one owner, they're going to default classify you as a sole prop. If you have two owners, they're going to default classify you as a partnership. The nice thing about LLCs is you're allowed to tell the IRS that you would like it classified differently. So without changing your legal entity, registering something new with the state, hiring an attorney and writing up a new operating agreement or anything like that, we can file paperwork with the IRS and get your business taxed differently if it is advantageous to you. So most of my clients who have a business, if you're the only owner and operator, don't have any employees, and you're making, $50,000 to $60,000 net income, just leave it as a Schedule C, sole proprietorship from a tax perspective. The additional complication and administrative burden of switching to an S-Corp would be way more than the extra savings of a couple $1,000s that you would get. And that's because when you switch over to an S-Corp, you have to pay yourself a reasonable salary. And then the leftover is where you avoid the extra FICA taxes. And so if you don't have enough net income, that reasonable salary is going to eat up most of your net, and then you're still paying FICA taxes, but now you have a separate tax return that you have to pay for. You have to file payroll taxes returns, pay payroll taxes, and send yourself a W-2. So once you hit around $100,000 or more and you're consistently hitting that number and expecting to grow, that's when we look at, let's switch you over to an S-Corp, get you a reasonable wage, and then you can get a good amount of tax saving. And then the higher your net income goes, the better the tax saving is. So yes, question about home office. If you are a renter and you don't own your house, you can still get a home office deduction. But the important thing is the space per the IRS, your home office has to be just used for work. And so even if it is in the corner of a room, as long as that square footage is just used for work, we can get a home office deduction for it. So we'd get a portion of your rent, utilities, etc., based on the square footage of that little space that is just your office. Any other questions? All right, I think we'll move on for now. Couple more slides, and then we'll finish up with final questions. So this next slide is special cases. And what I mean by special cases is these two cases aren't really an individual or a business. They're kind of somewhere in between. So this is a new thing for the last couple years, maybe 3 or 4 years. Statutory employee. So if you're a W-2 employee, there's a box on your W-2 called statutory employee. If you have that box checked, you're special. You're a special type of W-2 employee. And then what's special about you is now you can deduct from your gross wages any expenses related to that job that aren't reimbursed by your business. So travel costs, home office, there's a bunch of things that you can now deduct from your gross wage that you would not normally be able to if you weren't considered a statutory employee. There are credits and other things that you don't qualify for because you are a statutory employee that a sole proprietorship would qualify for. but you are still able to deduct a good amount of expenses. So if you are a statutory employee, you are unique and you have some additional benefits. Normally, these type of employees are in the sales world, so they get lots of commissioned revenue as part of their W-2 income. And so if you aren't in a sales position and most of your income is from commissions, it might be worthwhile talking to your HR department about if you can become a statutory employee, what that looks like, etc. Because there's benefits to it, and then there's some downsides because the statutory employee falls in the employee to 1099 contractor area of regulations in the middle. So you will still get some benefits from being more like an employee, meaning the business still covers your FICA taxes, but there are some things that the employer isn't allowed to do for you that they would be for a full employee, but then you get part of the benefit of a 1099 contractor by being able to deduct some of those expenses. And then the last special case is if you're part of a large partnership. So you get a K1 and you're a general or active partner in that multi-member partnership, but you're not like a, more than 20% owner. You're a small owner, but you still are an active and general partner. We can still deduct expenses that partnership does not cover for you that are related to the business. So I apologize for the typo there. There's a period there that shouldn't be there, but that's okay. So if you get a K1 and you're an active partner and you have expenses related to that business, we can still deduct those expenses even if the partnership does not reimburse you for them. So it's something to keep in mind if you're in that situation. But those are two special cases that don't really cover a whole lot of people, but I thought they were worth mentioning. And then lastly, why I think it's important to have a strategy. Like having a budget, having a strategy is important, not because it is precisely what will happen, but it helps you know what could happen and to plan for those outcomes. The goal isn't to come up with a strategy and a plan that works perfectly out throughout the future, but gives you an idea of possibilities so you have the ability to change things or understand what's happening. A tax strategy helps to align your overall goals, family, business, retirement, business, life, business, with your other goals to better achieve them. Without a strategy, your taxes might be working against your other goals without you knowing it. So it's just good to get an idea of what's going on. Some strategies are simple. A lot of W-2 employees, your strategies are going to be super straightforward, make a lot of sense, not a lot of complexity to them. If you're a small business owner, they can be a lot more complex, but having one helps you know where you're headed and if you need to change course. So any additional questions? Otherwise, that's kind of a wrap up there. I did see the one about the last minute contribution for taxes. We did talk about this a little bit. For businesses, what's nice about retirement contributions is you can actually push those contributions even further out into the next year for the prior year. So if you're planning on doing a large contribution to your 401k or SEP IRA, and we file an extension in March, you can actually do those contributions all the way up until September, I believe, is the deadline. I don't remember off the top of my head what 6 month is, but the 6 month deadline at the end of the year. So you can actually not make those contributions for 2025, you're filing your tax returns for 2025. Those are due at March 15th for your business. Instead of paying them in 2025 or on March 15th, you can file an extension and pay them in third quarter of the year. So even if you don't have maybe $10,000 that you want to contribute or $25,000 you want to contribute at the end of the 2025, you have almost the whole year to come up with that cash to contribute for 2025 to lower your tax liability. So it's kind of a nice thing there. If there are not any other questions, we will end there. Again, if you attended today, would love to have a 20-minute free tax planning call for you, go over anything you have, and I normally follow up with an email of overview of what we talked about. That way you have the information we talked about in a text format. We can help clarify moves for you and identify opportunities to save you 4 years end. So let us know if you want to take advantage of that, and we'll get you scheduled. Again, here's our information. Shoot us an email, check out our website, or drop by one of our office locations. If you were going to drop by the office, you probably should call ahead because a lot of times we have meetings or schedules or working with clients. So it's best to call ahead so that we can make sure we're available for you. Well, that's all I have for today. Thank you for attending. Sorry about the audio issues at the beginning. And enjoy the rest of your day.